Harold Chen sat at his kitchen table on a Tuesday morning in February with a single sheet of paper in front of him. It was the last mortgage statement he would ever receive. He was 71 years old, retired engineer. 41 years of paychecks, half of them split between the grocery bill and that mortgage. His wife Linda had passed 18 months earlier. And on that Tuesday morning, he looked at that final zero balance, folded the paper in half, and thought to himself, "Oh, we did it." His daughter called to congratulate him. A neighbor came over with a bottle of wine. His son-in-law, who had been renting for 22 years, sent a string of jealous texts. Harold felt untouchable. He thought he had beaten the system. And I am here to tell you, with everything I have seen working inside retirement planning, that in that moment of pure, hard-earned relief, Harold had also just activated one of the most expensive tax traps in the entire federal code. He didn't know it. Nobody told him. And that is exactly why we are here today. Here is what I need you to understand before we go any further. This is not Harold's mistake. It is not a flaw in his planning. Harold did what every financial advisor, every mortgage lender, and every well-meaning family member told him to do for 4 decades. Pay off the house, build equity, own it free and clear. And for most of the 20th century, that advice was correct. But we are not living in that century anymore. In 2026, a paid-off house is not just an asset. For millions of retirees, particularly those who bought before 2005, it has become what estate planners are now calling dead equity. Money that is locked inside your walls, completely illiquid, growing in value every single year, and accumulating a tax liability that your family will have to pay on the worst day of their lives. The people most likely to get destroyed by this are not careless people. They are not people who ignored their finances. They are people like Harold, disciplined, responsible, exactly the kind of retiree who followed the rules their entire lives, and the rules changed around them without a single memo. So today, on the Retirement Insider, we are going to open this up completely. I'm going to walk you through the exact mechanics of the dead equity trap. I'm going to show you the real numbers, the IRS code sections, the dollar thresholds, the deadlines that vanish without warning. And then I'm going to give you the specific steps, most of which cost nothing, to protect your family before this becomes their problem. Stay with me. This one matters. Let me start with a question I keep hearing. Why is this suddenly such a big deal in 2026? Home appreciation is not new. Capital gains tax is not new. Here is what is new. When most of today's retirees bought their homes, in the 1980s, the 1990s, even the early 2000s, median home prices across America were between $70,000 and $200,000. Today, those same houses in those same neighborhoods are worth $600,000, $900,000, $1.2 million in some metros. The IRS exclusion that was designed to protect you, the one that lets a married couple shield $500,000 of home sale profit from capital gains tax, has not moved since 1997. Not a dollar, not adjusted for inflation, not adjusted for the housing market that tripled underneath it. So the exclusion that once covered nearly the entire gain on a typical home sale now covers only a fraction of it. The trap is not getting bigger. The houses are. And then there is the piece nobody talks about in the context of a paid-off home. What happens when one spouse dies first? Because that is where the tax clock starts ticking. And most surviving spouses do not even know the clock exists. Let me walk you through 3 specific layers of this trap, because this is not one problem. It is 3 problems stacked on top of each other, and each one makes the next one worse. Trap 1, the Section 121 collapse. Under IRS code, Section 121, when you sell your primary residence, you can exclude up to $500,000 of capital gains if you are married and filing jointly. $250,000 if you're single. You must have lived in the home for at least 2 of the last 5 years. For most couples, this looks fine on paper. Say, Harold and Linda bought their home in Columbus, Ohio in 1994 for $145,000. Today, it is worth $970,000. They have $825,000 of profit sitting inside those walls. While both are alive, their $500,000 exclusion shields the first half of that gain. They sell, pay roughly $50,000 in tax on the remainder, and move on. Painful, but manageable. Now Linda passes away. Harold is now a single filer. His exclusion just dropped from $500,000 to $250,000 overnight, without a letter, without a phone call from the IRS. It just collapsed, because that is what Section 121 does the moment you go from filing jointly to filing as a widow. Trap 2, the 2-year window that almost nobody knows exists. Here's the part of the tax code that your CPA may not have told you. Under Section 121B(4) of the Internal Revenue Code, a surviving spouse has exactly 2 years from the date of their spouse's death to sell the home and still claim the full $500,000 married filing jointly exclusion. 2 years. That is it. If Harold sells within 2 years of Linda's passing, His gain is $825,000. His exclusion covers $500,000, and his taxable gain is $325,000. He owes federal tax of roughly $49,000 plus state tax. Still painful, but he keeps most of it. If Harold waits because he is grieving, because the house is full of memories, because nobody told him about this deadline, the window slams shut. Now he sells with a single filer's exclusion of $250,000. His taxable gain jumps to $575,000. His federal bill alone could exceed $85,000. Add Ohio state tax, and the numbers push past $100,000. $100,000? Gone, because nobody told him the clock was running. I want you to stop for a second right now. If you own your home and your spouse has passed within the last 2 years or is in declining health, you need to know this deadline exists. I'm going to put the exact code section in the description below. Write it down. Bring it to your next meeting with a tax professional. This is the moment in this video where it counts. This is the one. Trap 3, the RMD compression nobody sees coming. It gets worse, and I want to show you how. When Harold was married, he and Linda filed jointly. The 12% federal tax bracket extended to nearly $97,000 of combined income. They had breathing room. The day Harold becomes a single filer, that bracket gets cut in half, down to about $48,000. But his income did not get cut in half. His required minimum distributions from his IRA continue. If he inherited Linda's IRA, his RMDs just increased. So Harold's ordinary income is pushing him into the 22% bracket. And when he sells that house, his capital gains stack directly on top of that ordinary income. Every dollar of capital gain that sits above the 0% capital gains threshold gets taxed at 15% or higher. This is the cruelty of the debt equity trap. The house does not hurt you in isolation. It collides with your retirement income at the worst possible moment, on the worst possible tax return, with no room to maneuver. I want to ask you something right now, and I mean this genuinely. Do you own your home free and clear? When did you buy it? And do you have any idea what it would sell for today? Drop those 3 things in the comments. The year you bought, your rough estimate of what it is worth now, and whether you are married or widowed. I read every single one, and I can almost promise you that when you do the math, you will find a number sitting inside your walls that you have never properly accounted for. Your comment might also be the thing that makes the next person who reads it finally pay attention. So take 10 seconds. Drop it below. All right, here is what you can actually do. 5 steps. Most of them cost nothing. All of them matter. Step 1, calculate your real basis today. It is free and it takes 30 minutes. Pull your original purchase documents. Then add up every capital improvement you have made since. A new roof, a kitchen remodel, an HVAC replacement, a finished basement. Every documented improvement increases your cost basis and reduces your taxable gain. If you bought for $145,000 and spent $60,000 on documented improvements over 30 years, your adjusted basis is $205,000, not $145,000. That $60,000 difference saves you approximately $9,000 in federal capital gains tax at the 15% rate. Start building that file today. Receipts, contractor invoices, permit records. All of it goes in one folder. Step 2, find out whether you live in a community property state. This one is critical, and most people have never heard of it in this context. 9 states: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin operate under community property law. In those states, when one spouse dies, both halves of the home receive a full step-up in basis to current fair market value. Meaning, Harold and Linda's gain resets to 0 the day Linda dies. Harold sells the house, owes nothing in federal capital gains tax, and walks away with the full amount. In Ohio, and in 41 other common law states, only the deceased spouse's half gets the step-up. Harold's half keeps its 1994 basis. Same house, same love story. $60,000 to $100,000 difference, entirely based on geography and a legal structure. Step 3, if you are in a common law state, ask one attorney about a community property trust. 5 states, Florida, Alaska, Tennessee, South Dakota, and Kentucky, have enacted laws that allow couples in common law states to establish a community property trust and opt in to the double step-up treatment. This must be done while both spouses are alive. The cost of establishing this trust is typically $3,000 to $7,000. The cost of not doing it, as we have just shown, can be $60,000 to $100,000 or more. That is not a close decision. Step 4. If your spouse passed within the last 2 years, talk to a tax professional this week. Not next month, this week. The 2-year window under Section 121(b)(4) is a hard deadline. It does not extend for grief. It does not extend for indecision. It does not care that you are not ready to sell. What it does do, if you know about it and act before it closes, is save your family an enormous amount of money. If that window is still open for you, this video may be the most valuable 20 minutes you have spent all year. Step 5. Establish a revocable living trust regardless of your state. Even in a community property state where the step-up is automatic, your home will go through probate if it is not inside a trust when you die. Probate is public, slow, and expensive. Statutory fees in many states run $30,000 to $50,000 on a $1 million estate. A revocable living trust costs $1,500 to $3,000 to set up. It bypasses probate entirely. Your family gets the house and the money without a court process that can take a year or more. That is the difference between leaving your children an inheritance and leaving them a legal bill. I want to come back to Harold for a moment. Harold eventually found out about the 2-year window, not from his bank, not from the financial advisor he had used for 15 years. He found out because his daughter watched a video, sent it to him, and they sat down together at that same kitchen table with a legal pad and started doing the math. He had 14 months left on the clock. He made the call. He worked with an estate attorney. He sold the house in time, claimed the full exclusion, and moved into a smaller place near his daughter in North Carolina. He did not get to keep everything, but he kept far more than he would have if nobody had said anything. The thing he told me that I keep thinking about, and he said it plainly, no drama, was this. I spent 40 years making sure that house was paid for. I just did not know I also needed to know when to sell it. That is what the dead equity trap really is. It is not a punishment for doing something wrong. It is a penalty for not knowing the rules of a game that changed while you were busy living your life. You now know the rules. Here is what I'm asking you to do with that. Think of one person, just one, who is over 60, who owns their home free and clear, who lost a spouse in the last 2 years, or who is watching a parent go through this right now. Send them this video, not because I am asking you to grow the channel, because the 2-year window closes whether they know about it or not. That is the difference between being informed and being blindsided. Subscribe to the Retirement Insider so you hear the next one while there is still time to do something about it. And I will see you in the next video.